Hey there, future finance whiz. Ever heard of calls and puts and wondered if there's some secret code? Well, today on Wythdrawl Investing Insights, we're cracking that code wide open. Dive in with us as we unwrap the mystery of calls and puts in the most fun and simple way ever. You'll be impressing your friends with your investing smarts in no time. What are stock options? Think of options like tickets. Just like a concert ticket that gives you the right to attend a show but not the obligation, because you can always skip it, stock options give you rights concerning stocks without making you buy or sell them outright. The power of calls, betting on a rise. Imagine your favorite sneaker brand is about to release a limited edition pair. You think the price will soar because everyone's going to want them. In the stock world, if you're predicting a stock price will go up, you'd buy a call option. It's like reserving those sneakers at today's price, hoping to sell them at a later price higher. If the stock price does rise as you predicted, you make a profit. If not, you just let the option expire, like not buying the sneakers at all. Puts, playing it safe with a cushion. Now, what if you're a bit pessimistic? Suppose you think those snazzy sneakers might not be so popular and the price might drop. Puts are your go-to option then. Buying a put option is like getting an insurance policy on your stock. If the stock price falls, your put shields you from bigger losses. But if the price goes up again, you can just let the option expire, no harm done. Why options matter? Options offer flexibility. They allow investors to hedge against losses, speculate on future prices, and even earn income. And while they might sound super technical, at their heart, they're just tools that you now understand. Alright, you've grasped the basic concept, but let's dive a tad deeper. How exactly do these options work in the real world of Wall Street? Expiration date. The clock is ticking. Every option has a deadline known as its expiration date. It's like having a concert ticket for a specific date. If you don't use it by then, it's worthless. So in the options world, you need to decide what to do before your option expires. Strike price, setting the target. Each option also has a predetermined price known as the strike price. For our calls, it's the price you agree to buy the stock at if you choose to use the option. For puts, it's the price you agree to sell at. Think of it as locking in the price of those sneakers before they hit the market. Premium, the price opportunity. Options aren't free. When you buy an option, you pay a premium. Consider it like a reservation fee for those limited edition sneakers. This fee varies based on factors like the stock's volatility and the time left to expiration. The key is, the premium is the most you can lose. If things don't go your way, your loss is limited to the premium you paid when buying an option. In the money versus out of the money. You'll hear these phrases a lot. If a call option strike price is below the stock's current price, it's in the money. You're winning. But if it's above, it's out of the money. For puts, it's the opposite. These terms can help investors gauge how their options are performing. Examples in action. Meet Alex. Picture Alex, an investor eyeing the stock of TechTitan Incorporated, a booming tech company. Rumors suggest they're about to unveil a revolutionary product, but there's a twist. No one's sure if this product will be a smashing hit or a massive flop. Buying a call, betting on success. Alex is optimistic. She thinks TechTitan's product could change the game and send the stock soaring, so she buys a call option, locking in the current stock price. If the stock shoots up after the product launch, she can buy the stock at a lower price, locked in, and sell it at the current higher market price, pocketing the difference. That's her potential profit. Buying a put, prepping for the unexpected. But what if the product flops and the stock plummets? Alex doesn't want her entire investment to take a nosedive, so she also buys a put option. This allows her to sell the stock at a locked-in price, even if the market price drops drastically. It's her safety net, ensuring she doesn't face catastrophic losses. Why both? The strategy of a straddle. Buying both a call and a put, Alex is creating a strategy known as a straddle. She's preparing for both potential outcomes, a stock price surge or drop. Whichever way the wind blows after TechTitan's announcement, Alex has positioned herself to either make a profit or minimize losses. This dual approach might seem contradictory at first glance, but it's a calculated move for uncertain situations. Options are not just about predicting market movements, but also about managing risks. In the unpredictable world of stocks and ETFs, strategies like the straddle help investors sleep a bit more soundly at night. You've already dipped your toes into the waters of buying calls and puts, but did you know that in the options market you can also be the seller, not just the buyer? This time, let's navigate the more advanced shores of selling calls and puts. Fasten your seatbelts, we're diving deep. Introducing Jordan, the investor with a plan. Meet Jordan, a seasoned investor with shares of Megacorp in his portfolio. Unlike Alex, who bought the option, Jordan is looking to sell options. But why? Let's find out. Selling a covered call, the rationale. Jordan believes his megacorp stock will remain stable or maybe even drop a little bit over the next few months. To capitalize on this belief, he decides to sell a call option on his stock. By doing this, he earns a premium from the buyer of the call. If the stock price remains below the option's strike price until expiration, the option won't be exercised and Jordan gets to keep the premium as pure profit and retains his shares. But there's a flip side. If Megacorp stock unexpectedly skyrockets, the call buyer will exercise the option. Jordan would have to sell his shares at the lower strike price he sold the option at, missing out on the higher market price, although it is still very likely that he made money. Selling a put, banking on the stability or rise. Now Jordan is also optimistic about another stock, Future Tech. He thinks it won't drop drastically and it might even rise, so he sells a put option. By doing this, he collects a premium. If Future Tech's price stays above the strike price, the put won't be exercised and Jordan pockets the premium. However, if Future Tech's stock price dips below the strike price, the put buyer will likely exercise the option. Jordan would then have to buy the stock at the higher strike price for which he sold the put at, even though it's currently cheaper in the market. Costs and benefits of selling options, the delicate balance. Benefits. Selling options can generate immediate income in the form of premiums. It's a strategy that can be lucrative, especially in stable or high volatility moving markets. Costs. The risks are tied to market unpredictability. When selling a call, you risk losing potential profits if the stock soars, and naked calls have unlimited risks, so you need to be very careful with those. Selling a put can lead you to buy a stock for more than its current market price, so it's a good idea to have enough cash on hand to buy the stock if needed for less than its current market price. So it's a good idea to have enough cash on hand to buy the stock if needed if a sold put works against you and the stock price drops. Selling options is like playing chess. Every move is strategic, with both potential rewards and risks. It requires deep understanding of market dynamics and a clear vision of your investment goals. If you're a newbie, better keep it simple first and avoid short positions. By now, you should have a clear picture of calls and puts. They're strategic tools offering opportunities for profit and protection against losses. But, as with all investments, they come with risks. The trick is to use them wisely, backed by sound knowledge and strategy. So next time someone talks to you about options, you won't be left scratching your head. Instead, you'll be nodding along, maybe even chipping in with your 2 cents. Stay tuned to Wythdrawl Investing Insights for more demystified financial concepts, and remember, the world of investing is vast, but with the right knowledge, you can navigate it confidently. Thanks for visiting us today at Wythdrawl Investing Insights. We hope you learned a thing or two. But remember, investing comes with risks, and you should be fully aware of them before choosing to invest. Consider consulting a financial advisor to help educate you on markets. And remember, past performance is not indicative of future results.